welcome to the webinar called A Closer Look at Global Inflation, Logistics and Supply Chain Disruptions. My name is Donald Moore. I'll be the moderator today. I'm the chairman of the Hong Kong Association of New York, and I'm also the managing director of a law firm I founded called U.S. Legal Advisors, PLLC. We focus on global defense, security, transportation, and infrastructure matters, both on Earth and in space. As I said, I'll be your moderator for today. Our event host is the Hong Kong Association of New York, and we give thanks to our supporting organizations, the Hong Kong Economic and Trade Office of New York, the Hong Kong Trade Development Council, law firm of Hill Dickinson, based in Hong Kong, and World Trade Week in New York. So some general reminders before we start. Those of you who've been with us before will be familiar with these. The event will be recorded for promotional purposes. That means it may be replayed later on YouTube and other locations. So you should know that before you maybe speak. All comments made in the program do not necessarily represent any official views of the various speakers, organizations, or employers. Everybody else will be muted during the presentation, but there will be opportunity for a question and answer, but that will be by submitting your question answers in the Q&A box at the bottom. The chat box will be closed for questions, but it'll be open in case you have technical or other matters. You can put your questions there, and I'm sure they'll be quickly answered by Michelle. So this topic in this webinar, frankly, could hardly be more timely. Global inflation is really affecting stock markets, corporate and individual budgets and costs around the world. It's in the news on a daily basis, and anybody looking at their investment accounts will recognize that it's affecting those to the negative and may well lead to an eventual recession in many parts of the world. So quickly, our agenda, as I said, I'm doing the introduction. My name is Donald Moore. I'll introduce each of the following presenters as we go forward, but we'll have opening remarks by Ms. Candy Nip, who is the director of the Hong Kong Economic Trade Office in New York, and Mr. Paul Sheard, Dr. Paul Sheard of Harvard, will be discussing global inflation. Damien Laracy, who is a partner at Hill Dickinson, and that firm is also a member of Hong Kong Association of New York, will be giving observations from the private sector on logistics disruptions. And Ms. Alice Tsang of the Hong Kong Trade and Development Council will be talking about supply chain updates. And as mentioned, we will then have Q&A. We have actually several submitted questions already, more than we normally do. And so I will be doing my best to sometimes combine maybe repetitive ones and get everybody's questions answered. So why don't first we can introduce Ms. Candy Nip. She has held multiple positions and high-level positions in Hong Kong government, including in Europe, focusing on bilateral ties with the EU, and in Hong Kong, focusing on transportation and housing matters. And Mr. Sheard, as mentioned, is an economist, research fellow at the Harvard Kennedy School. In addition to his focus, macro aspects of inflation, implications of geopolitical competition, etc. If you happen to look him up anywhere, including on Wikipedia, you'll see his CV, and his activities are so extensive there'd be too many to mention here. Otherwise, it would take up most of our event. So he'll be going second. Mr. Laracy, Damien Laracy, is a litigator in the Hong Kong office of Hill Dickinson. He focuses on recent logistics disruptions and commodity pricing, price inflation, and other matters regarding business. His specialty is commercial litigation, international arbitration, and insolvency litigation. And Ms. Alice Tsang is assistant principal economist at the Hong Kong Trade and Development Corporation, based in Hong Kong. To my understanding, she's been there over 15 years, which is quite impressive. And she heads up the Greater China Research Team at that institution. So, as mentioned, we'll do live Q&A at the end. So, why don't we start with Candy? and she'll make some opening remarks, and we'll move on from there. Candy?
Thank you, Don. Good evening, friends in the United States, and good morning to those in Asia. I would like to warmly welcome all of you to this forum on the impact of global inflation in the context of logistics and supply chain. As Don has just said, such a timely topic and a timely event, and I give credit to the Hong Kong Association of New York for their hard work in putting all these together. Alongside the pandemic and the war in Ukraine, I guess inflation is probably the next most talked about topic in the international business community nowadays. Wherever you're doing business in and whoever you're doing business with. The IMF, you probably might have picked that up as well, revised downward the world economic outlook by almost 1 percentage point, from 4.4% to 3.6% in the end of April, only 1 quarter into this calendar year. This was rather unusual. And this downward adjustment was accompanied by a significant increase in projected inflation as well. In March, the consumer price index in the United States was up by 8.5%, the highest spike since 1981. The Eurozone inflation surged to 7.5%. In Asia, while relatively less severe for the time being, prices have also been edging up. So with all these chilly forecasts and stark figures suggesting erosion in consumer purchasing power, what should we be expecting in the global economic environment? How much is supply chain disruption playing a part in it? What tools do governments worldwide have to mitigate the hardship of the people? Zooming into Hong Kong, being an extremely externally oriented economy and as one of the world's busiest aviation hubs, seaports, and logistics hubs, Hong Kong is certainly among the key players in the global supply chain. How did our industries navigate this uncharted water in the past 2 years? And what lessons did we learn? With all the uncertain macroeconomic factors, as well as the ever-heightening geopolitical tensions, the sail ahead of us is expected to be choppy. How can Hong Kong continue to build on its institutional strengths and locational advantages to outmaneuver these challenges? And most importantly, why would Hong Kong be relevant to you and your business? I know I have thrown to you a lot of questions. Therefore, stimulating your thoughts with Don and I today, like he just introduced, are 3 distinguished experts from across the academic, business, and legal sectors. I will now pass the floor back to Don so that he can moderate this discussion. And I hope you will enjoy today's seminar and find the information useful. Thank you very much.
Thank you, Candy. And we're going to move on to Dr. Paul Sheard. As I mentioned, he's an economist and research fellow at the Harvard Kennedy School. I also just count him as a really good friend of the Hong Kong Association of New York. And he's helping out on a regular basis. And when we used to meet in person, he was always there at our good events, and hopefully we'll be again soon when we continue with those. So Paul, I hand it over to you.
Oh, great. Thank you very much, Don, and welcome everybody to the webinar today. So let me sort of approach this topic playing to my sort of expertise, which is more on the sort of the macro side. And I think with Damien and Alice, we'll get into the sort of supply chain issues at a more sort of micro level. But let me give you the sort of the bird's eye view from the sort of macroeconomist perspective. And Candy has already given some numbers. As it happened, actually, good timing, the April CPI report came out for the US, came out today. The number for April year on year was 8.3% CPI inflation. So that ticked down a little bit from the 8.5% that was there in March, but it was above expectation. There is a bit of a favorable base effect to inflation because COVID really hit, if you remember, March, April 2020. That initially forced inflation down, but a year later, as the economy recovered, it sort of went up more than you would expect. And now we're in the next phase of that cycle with a base effect from April onwards, which is favorable for bringing inflation down. But it's got a long way to come down from 8.5% peak in March. So what's going on here? Obviously, among economists and policymakers and central bankers, a lot of people are scratching their heads and debating, how to understand this, because this was not forecast by very many economists. Yours truly included, but if you look at the Fed, for example, the Fed makes forecasts every quarter of inflation, GDP, its own federal funds rate, interest rate, sort of 3 years out. And they spent all of 2021 just chasing inflation, and they've done the same thing in 2022. Every time they issue these forecasts, they have to kind of raise their inflation forecast, really kind of chasing the inflation numbers. So at a very simple level, if we have generalized inflation, that is the overall price level, the CPI, is rising at 5, 6, 7, now 8%. Anybody who's done any basic economics would say, well, it must be that there's too much demand relative to supply. That almost follows definitionally. Too much money, too much purchasing power, too much demand, chasing not enough goods. And what happens is prices start going up, relative prices shift, but they're all going up sort of together. And in fact, if you look at the CPI report in the US that I mentioned, since November of last year, there's an interesting phenomenon, which is that every subcomponent of the CPI is in positive territory, and some of them are very big. Energy's up 30% year on year. Food's up 9%. But what you typically see, Don, when you look at a CPI report in normal times is some things are going up, other things are going down, and they kind of, to a large extent, cancel out so that you end up with this nice kind of 2% inflation. What's different about this episode is kind of everything's going up. It's just that some things are going up more than others. Now, a lot of people are saying, well, I mean, too much demand relative to too little supply. Why would that be? Well, it must be because of all this government spending that's taken place. It must be because of all this money that's been printed. And there's an element of that, but I'll sort of push back against that to a significant degree. It's a little bit misleading, that story. Let me explain why. Well, federal debt, if you look at the total debt of the federal government in the US, and I'll stick mainly to the US, but we could tell a similar story in Europe in particular, to a lesser extent in Japan, has gone up from about $17 trillion pre-crisis, pre-COVID, that is, to about 23 now. So that's up about $6 trillion. That's about a quarter of GDP. So that's a lot of debt to be added to the system in a couple of years. Meanwhile, the Federal Reserve has taken its balance sheet pre-COVID was about $4.3 trillion. Now it is $8.9 trillion. So it's increased by about, the Fed has pumped up its balance sheet through this so-called quantitative easing by about $4.6 trillion. Again, a very big number. If you went back to the financial crisis, the Fed's balance sheet then, 2008, was less than 1 trillion. So in this 2-year period, they've added to their balance sheet, almost 5 times the size of their balance sheet back in the financial crisis. So, these numbers are kind of off the charts. So you would sort of say, well, wow, that must be the driver of this runaway or very high inflation. And I would say, hold on a minute. You've got to look at the context. And if you go back to COVID in March or second quarter of 2020, the initial effect of the lockdowns was, of course, a dramatic negative shock to economic activity, to GDP. And the numbers that we saw in the first half of 2020, particularly the second quarter, we have never seen numbers like this before. I cannot emphasize how dramatic a negative shock. It put the global financial crisis and the Great Recession, to shame. I'll give you one statistic. The unemployment rate in the US went up from 3.5% in February 2020 to 14.7% in April, 2 months later. So 11 percentage points, something like 22 million jobs were lost just in those 2 months. If you go back to the financial crisis, again, it's the Great Recession. The unemployment rate in the US went up from pre-crisis 6.1%, reached a peak of 10%. So it went up about 4 percentage points. That took 14 months. This time, 11 percentage points in 2 months. So the economy was really falling off a cliff into the first half of 2020. And that was the context in which governments around the world spilt a lot of fiscal ink. Essentially, they created a lot of money, and they transferred to households, to companies, to kind of keep the economies in suspended animation so that they could resume growth and resume economic activity when the COVID shock passed. And that's exactly what happened. So, we could argue about, well, didn't they go overboard? I think particularly the American Rescue Plan that came in at the beginning of the Biden administration, in retrospect, probably was not needed anywhere near on that scale. So yes, we can have the debates about the appropriateness of the size and content of the fiscal and monetary stimulus. But I would argue very strongly that the main story was on the supply side of the economy. And particularly the labor market and supply chains, which the other panelists will talk about in more detail. And of course, those two things are connected, because one of the major reasons that supply chains have become so dislocated and such bottlenecks have developed in supply chains is that there have been labor shortages, and the labor market has been quite dysfunctional or damaged by COVID. Now, the unemployment rate is back to 3.6%. So I mentioned before, it went up to 14.7% in the US. It's back to basically where it was, a very low level before the COVID hit. Job offers are running at around about 11.5 million. Well, pre-COVID, that number was around about 6 million. So the labor market is very hot. But there are about 4 million workers missing. For example, if you look at the number of people in the US who are not in the labor force, that number pre-COVID was 95 million. So these are people who've retired, they've dropped out of the workforce, they may just not be in the workforce for various reasons. 95 million. That number is now almost 100 million, 99.5. So 4.5 million people have kind of disappeared from the workforce. And you can look at that number from different angles. You'll see the same picture. And again, why is that? Well, many factors at work, but clearly the COVID shock, the lockdowns, the mask mandates, the vaccination mandates, all kinds of things that really turned society upside down, had a dramatic effect on the labor market. And that also has impacted on supply chains. So I think that's the key kind of, if you say, well, okay, supply and demand are like a pair of scissors. They interact to give you a certain level of inflation or price pressure. So it's again, it's a little bit strange to say, well, it's one or the other. It's sort of both of them. But I think the major culprit is on that supply side, because if you look at the macro data, what you see is that the economy has sort of got back pretty much to where it should be. So, for example, the level of real GDP in the US, it's about 3% above where it was at the end of 2019. Now, you'd normally expect it to be 4.5%, 5%. So it's not quite, back to where it would have been, but it's not, in a sort of a historical or a trend sense. The outlier does not appear to be the level of economic activity. The really prominent and puzzling thing is that at full employment, the economy is missing a lot of workers that were there pre-COVID, and they may or may not come back. And you see this again if getting back to the supply chains popping up. For example, one of the components that has been driving up, it's worth about 4% of the CP index, contributes about 4%, is used car sales. Used car vehicles, the number today, that was up about 23% year on year. New vehicles, more around about 13% or so. But we've had this story in the US in particular of semiconductor shortages. That means that harder to get your hands on a new car. People have been turning to used cars, and that's pushing up temporarily the price of used cars. That's feeding into inflation. So I would lay more of the blame at the feet of the supply side of the economy than the demand side per se, because I think in many ways the central banks and governments have been successful in getting economic activity back and getting these quite strong V-shaped recoveries, which other things equal is good. However, having said that, I do think that central banks have been slow to act. Why do I single out central banks? Because the primary responsibility in the kind of the modern system of macroeconomic policy that is standard across the world is that the central banks are given the main job of controlling inflation. That is, if inflation is too high, they're the ones that governments and the markets and the private sector look to rein in demand. Now, they were very slow. One of the reasons, maybe the principal reason that they were slow, was that they did understand that a lot of the inflation was being driven from the supply side, and typically supply side shocks self-correct. And so central banks often will kind of look through supply side shocks because they say to themselves, to use the famous word now, the higher inflation should be transient. It should be self-correcting. The problem is when a central banker says transient, or an economist says transient, they may be talking about 1 year, 1.5 years, as gradually these relative price moves, which have driven inflation high, start to unwind and self-correct. You see this with oil prices in particular. Headline inflation will sometimes go up quite a bit, then it will come down again because oil prices go up and then they come down, and that will drive inflation as well. But having said that, I think central banks were far too slow. And even today, we see the ECB has an interest rate. I mean, inflation is running at 7% or so, and yet the ECB is maintaining its policy rate at minus 50 basis points. You heard that correctly. They still have a negative interest rate policy in the euro area. And the ECB is still expanding its balance sheet, which is monetary easing. So you say to yourself, hold on a minute, we've had a fair few months now to figure out that while this may be supply side driven, it's not self-correcting anytime soon. And central banks need to rein in demand. The Fed has started that process already in the last March through May. The Fed has raised its interest rate by 75 basis points. They've essentially told the markets in the next, by July, 2 more meetings, there'll be another 100 basis points, and they're going to keep going beyond that. They're also going to start shrinking their balance sheet in June. But again, I think the Fed was also quite slow to act. Last point I'll make, pardon me, is that while we have this very elevated inflation, we now have central banks scrambling to catch up. We have this new shock, which is Ukraine and Russia. Now, obviously, a very geopolitical event and takes the discussion a long way away from pure economics. But Russia and Ukraine, of course, are major suppliers of energy, particularly Russia, food, fertilizers, minerals, rare earths, all sorts of things. And you could not have a worse time or timing for another round of supply shocks, supply side shocks, particularly disruptions to the global supply of key commodities. You could not have envisaged a worse time for all of this to be layered on top of the COVID shock that we are still operating in the shadow of. So this puts central banks in an even more difficult position. They'll probably have to play catch up even more. And that does run the risk of the R word that you mentioned, Don, that very often where you get a recession is from central banks having to cool down an overheating economy. And because monetary policy works with famously long and varying lags, they may overdo it, and the economy falls into recession, in which case they have to then start tacking back in the other direction. So the next year to two, not just from a geopolitical perspective, not just from an inflation and economic perspective, but from a policy making perspective, is standing to be a very, very challenging one. So I'll stop there and hand it back to you, and look forward to hearing from the other panelists.
Thank you so much. A couple of points to most your last few points there. Chairman Powell called it transitory and redefined what transitory was, and then stopped using the word. And might have been a chance that they would have been right about that had not the Ukraine war started and the effect on fuel. And
sorry, Don, you're breaking up a little bit there, but that was a question back to me.
Yeah, can you hear me?
Yes, yeah, you were breaking up a little bit, but that was a question to me. Yeah, no, I mean, I think if we just forget about Ukraine and Russia, most of this was already happening. The problem with the Russia-Ukraine situation is now, over the next year, the central banks may have been able to, successfully steer inflation slowly back down towards their 2% targets. The Ukraine and Russian situation sets them back dramatically. Yeah. So it's one shock layered on top of another. And that really, again, central banks have to look forward. They have to be forward looking. And when they were thinking in the second half of 2021, how much do they have to do? How soon do they have to do it? They were looking into 2022 and thinking about how it would evolve. At that point, they were not seeing the Russia invasion of Ukraine and all the consequences of that. So it just multiplies the challenge that they have.
Yeah, for sure does. Great. Well, thank you for that. Of course, we'll have more questions later on. Let's move to Damien. Damien's going to give us, as I mentioned, comments and observations from the private sector and from a very active lawyer in Hong Kong. Damien?
Thank you. Thank you very much, Don. Can you hear me?
Yes, I can.
Okay. And Paul, thank you very much for those helpful remarks as well. So I'm an international trade lawyer. As per Don's introduction, I spend a lot of time arguing in court and arguing in an arbitration setting about commodities disputes and shipping and trade work generally. Now, underneath all shipping contracts, underneath the general arrangement pursuant to which goods move around the globe, there will always be a bill of lading and there will always be a charter party. And for those of you that are proud New Yorkers, I thought I would mention very briefly that one of the best known charter parties, and certainly one perhaps that has the longest longevity, is the New York Produce Exchange form, which dates back to 1913. That has been regularly updated over the years by BIMCO, with the most recent version being released in 2015. So it is that type of document that will always provide the entry point for lawyers into these types of disputes, because at the back of a document like that, you will normally see an arbitration clause. Now, the current NYPE form has only 57 paragraphs, but again, it's very common for parties or their brokers to insert numerous other paragraphs beyond that as well. So at times it will be hard to see the arbitration clause in there. but inevitably there will be one, and it will normally provide for any disputes to be resolved in probably New York, London, Hong Kong, or Singapore. So that a lot of that is a gross generalization, but that's the general shape of the way in which people like myself get involved in Charter Party disputes. Now, going back then to supply chain logistics and disruptions, I can see sort of from the way that my personal legal practice operates, four real drivers. One is war and conflict. One is government directives and intervention and private arrangements. A third would be pandemic response measures. And the fourth would be perhaps the more everyday, ever given type incident. So I thought I would just start off reminding us all about the Ever Given from March last year, because I think I can then segue into making the point that that actually provides a good reminder of how so much inefficiency is currently baked into our international trade system. So going back to the Ever Given, you may recall that she was blocked in the Suez Canal for 112 days from the 23rd of March, 2021. There were 18,300 containers on board with a total cargo value of $780 million. So that's a lot of cargo going nowhere for 112 days. So there's a massive inefficiency there. The contractual nuances and niceties around how 18,300 containers get transported around the world is of course what keeps people like me and others in my industry so fascinated with international trade. But there's also always a human interest element as well. So in this particular case, there were 25 Indian crew on board, and they were all safely repatriated after sailing on to Rotterdam. So compared to some of the challenging and gloomy statistics that we're reading in the news and some of the other bad news generally from Eastern Europe, the Ever Given, with the benefit of some hindsight, was in fact quite a pleasant story, except of course if you are the Japanese owner that I believe is still engaged in negotiations with the Egyptian government about compensation. Lloyd's List has tried to put some numbers around the inefficiencies that resulted from that vessel being detained in the way she was. They have come up with a number of $9.6 billion, being $5.1 billion of wasted waiting cost for westbound cargo, and $4.5 billion for wasted waiting cost for eastbound cargo. So again, an isolated incident, but very obviously enormous inefficiencies arising from that. Which brings me on now to my first slide. Sorry, now this is an extract from a report prepared by Royal Bank of Canada very recently. And they have said that there is approximately 1/5 of the world's global tonnage either laid up or stuck in congestion. So again, we saw an obvious example of inefficiencies with a single vessel, the Ever Given. And then look at the next line here. There are currently 300 ships awaiting a berth in Shanghai. Now that's 300 ships with cargo and with crew. So again, Paul made the point earlier that there are enormous challenges in dealing with the labor situation generally as it feeds into inflation propositions. Shipping from China to the United States is now taking 70 days longer than usual. Now, again, part of that story is due to a labor narrative. People are not able to move around the globe as quickly as they used to be able to. They're not able to reposition quickly to meet a ship in order to ensure that there's a full crew. And then some of the other statistics there towards the bottom of that slide, I think you've probably seen regularly enough in the news. There's a lot of pessimism about fuel prices and a lot of pessimism around insurance premiums. So both of those directly impacting on the costs of doing business if you're a ship owner. There's a similarly gloomy slide here, which I've extracted from another source. Now this comes from the Oxford Economics publication. And it may make more sense to Paul than it does to me. But what you will see here is that instead of talking about inflation in the global supply chain process, what the authors of this chart have done is they've broken down 5 drivers. They've identified levels of activity, levels of transportation, pricing levels, inventory costs, and labor levels. And what they have then produced is this chart, which is showing that the stress of the global supply chain system is increasing substantially and has done just in a relatively short period of time. And again, I think that that probably overlaps with some of what Paul was saying about us living in unprecedented times in terms of unemployment. So the main point there was, rather than speaking in general terms about inflation, the authors of this chart have broken out 5 constituent elements: activity levels, transportation levels, prices, inventory levels, and labor. So again, I think making a similar point to the one that Paul made, but diagrammatically. Moving on then, talking about legal impediments. So obviously the Ever Given provided an enormous physical impediment to trade through the Suez Canal for 112 days. Legal impediments that keep people like myself busy at the moment obviously include advising on insurance coverage if a vessel is wanting to trade anywhere near a conflict zone. Obviously advising on sanctions. We've been very busy recently turning away work, which is never pleasant, but entirely necessary. And also crewing issues. And again, I come back to crewing because one of the points I will make at the end of this is that the experiences of so many global seafarers at the moment are not good. They're not positive. They're being trapped on vessels for long periods of time, not necessarily with a clear roadmap as to how they'll be treated, when they can leave, etc. And there is some literature suggesting that if we don't fix that sort of experience for the global seafaring community, then we will be woefully short of seafarers in a relatively short period of time. So we advise regularly on repositioning crew. There's also an interesting point that was raised with me recently as to whether a vessel might be unseaworthy if on the bridge of that vessel there was a Russian master, let's say, and a Ukrainian first officer. Now, obviously, when people are maneuvering large pieces of machinery, expensive pieces of machinery, there needs to be good communication. Is it the case that if one had a scenario like that the vessel could be deemed to be unseaworthy? Obviously, a very difficult one to make a generalization about, but the matter has come up recently in discussions with one of our clients. And I don't know just what the level of animosity is between the 2 particular individuals that were identified, but I think a decision was made to try and separate them in their shifts at least. Another crew-related piece of inefficiency that we are seeing regularly involves, for example, crew on board a Chinese vessel, might be a Chinese crew looking to lift cargo in Korea. so this again was an incident that we were involved with recently. The Chinese master produced to the Korean authorities the vaccination evidence from Shanghai, but was promptly told that the formatting was wrong and it needed to be presented in either English or Korean. Now, 2 days then passed whilst that vessel lingered at the load port, whilst the correct documentation was sourced back in Shanghai. So again, somebody is paying wasted hire for those 2 days. Some crew are twiddling their thumbs. Bunkers are being wasted. There's an enormous amount of efficiency that has been baked into the current and perhaps necessary mechanisms that we're using to deal with COVID. But that level of bureaucracy, if unattended over time, if we don't find a way to break down that extra layer of bureaucracy, then it is going to be very difficult to go back to the sorts of efficiencies that we all recall so fondly. And then just finally, I'd like to mention Michelle, if we could go to the slide dealing with economic and regulatory issues. We've also seen, so as I said initially, obviously we can see supply chain disruption from wars and events of conflict. We can see it from pandemic issues. We can see it from ever given type issues, but we can also see supply chain inefficiencies arising from government directives. And we've had a very good example of this sort of closer to home recently with the Indonesian government directing that there were to be no more coal exports from Indonesia due to concerns about domestic availability. Now that does raise questions of force majeure. Some of them will be legitimate, some of them will be contrived, but and especially if there's a sense that the market is going to be a rising market, then as many of us will be aware, there will be efforts made to try and renege on a existing contract in order to try and sell a cargo, including a cargo of coal, to a higher buyer on a rising market. So we've seen a lot of commodities disputes recently due generally to price fluctuations and spikes. So that was really all I had to say. As I say, my real point is that there is a lot of inefficiency in the system at the moment. Obviously, it's in all of our interests to try and remedy that. Some of that will be less easily said and fixed than others. But the other thing that we do need to remember, those of us that are invested in this, in the international trade community, is that we have to try and find a way to tell our seafarers that they are being looked at and that things will be improving for them, or else we will be struggling to attract people to that very important industry.
There we go. Thank you, Damien. Very interesting. I spent a lot of time in my earlier career in logistics and distribution, including just-in-time delivery systems, and sometimes so-called efficiencies turn into inefficiencies. Reminds me of Warren Buffett's great line about when the tide goes out, you see who's been skinny dipping and not really doing it right. But my real question to you is on the legal side: are you noticing more issues in certain jurisdictions in Asia than others, and why might that be? Or it's really sort of regional, completely regional?
I think we've seen more recently in relation to Indonesian coal. Obviously, there's also been some tariff and trade activity as between Australia and China as well, yeah, closer to home. But no, these disputes are largely sort of jurisdiction agnostic, except when you get a significant intervening act such as what the Indonesian government has done.
Super. All right. Well, we want to stay on time, and maybe we're a couple minutes behind, but we certainly don't want to shorten Alice's presentation. So, Alice, I'm going to turn it over to you, and you can tell us a perspective of yours and perhaps from the Hong Kong Trade and Development Council.
Okay. Thank you, Don. And can you hear me well?
Yep, pretty good.
Oh, Okay, that's good. Yeah. Okay, good day, everyone. And this is Alice from Hong Kong. And thank you, Paul and Damien, Fascination Sharing. And as a part of Hong Kong Trade Development Council, and I'm going to share with you some supply chain updates, not just in Hong Kong, but also in mainland China as well, and how Hong Kong traders and manufacturers are dealing with the supply chain disruption recently. So without further ado, and I would like to point out that even though after past few years, Hong Kong was under the shadow of China-US trade dispute and the pandemic, and which brought us logistic bottleneck and all those inflation and rising transportation costs, China is still the world's factory because we have the most biggest MNC plants in the world. And the lingering of the China-US trade war has made some of the companies and think of those idea of China plus one strategies again, or you call reshoring from China again. Well, however, face it reality, not all manufacturing products could be relocated so easily. Some products such as garments or leather goods, which require less technological involvement, they may have been expanded or moved to ASEAN countries, especially Vietnam and Indonesia, with cheaper labor costs. However, most of the production of more sophisticated, such as electronic parts and components, for example, iPhone, laptop, or microchips, in China and Japan and Taiwan are still playing a dominant role in Asia in the region. So in view of the global economic challenges, in last year, the China's 14th five-year plan announced by the mainland government, China is going to upgrade its manufacturing capabilities by 2025, while 8 priorities areas, which including AI, robotics, cloud computing, and industrial applications, and etc. So in the past 2 years, even with the pandemic, we can see that China exports in last year actually grew by 30%. And since Hong Kong is a major trading partner with China, Hong Kong is a re-export hub, most of our goods are re-export from origin from China to other parts of the world. And with China's strong export performance last year, Hong Kong exports also surged by 25%, indicating that Hong Kong and China are playing a very closely tied role with each other during the export performance and the supply chain as well. So it has been more than 3 years since the first COVID outbreak. And however, I think China is still the only country we keep the zero COVID policy in the world. So currently we can see that China is in Shanghai, most factories or the whole city is still being locked down, and people tested positive COVID and still need to be go to the centralized government quarantine facilities. However, the COVID situation in China is not getting better because there are cases in Beijing and Zhengzhou in the middle part of China, which have caused partially lockdown recently in May. And although some big MNC, for example, Foxconn, one of the biggest producer of iPhone in Zhengzhou, their facilities although has been closed, but they have been working as a closed loop system. So workers are moving on a point-to-point basis between facilities and their dormitories. So in this case, some manufacturers in China can still provide manufacturing services or production in the regular terms. However, there is questions about even though they can maintain their production, however, they can't ship out their goods and products or semi-parts of components. So therefore, manufacturers in China actually are looking in different ways to ship out their goods to the rest of the world. For example, like in the ASEAN countries, like China can still ship out their goods like via the rail instead of going to sea route. Like for example, like at the beginning of this year, the China-Laos Railway has been opened, and people like manufacturers are trying to shipping like their goods to ASEAN through rail. If shipping out from China to Europe, they are using the rail called USNO, which it takes like 40 days ship out goods from China to Germany. So actually, manufacturers in China like are looking like alternatives routing to solve the logistic problem. So in the first quarter of this year, like China exports still managed to up by 15.8%, and the import is still going like doing positively with the growth of 9.6% year on year. And talking about like the Shanghai problem, we can see that this is a satellite image from outside China. Like you can see that like bunches of like containers are waiting outside China to for docking in April. So we can see that Shanghai and the near port like Ningzhou, it is very like heavily populated, and like the vessels and the container and the crew are still waiting on the sea. So there is a questions about like China's zero COVID policy is actually like not helping like the supply chain in China, and there is like causing a threat like to like the global supply chain issues, like because if China cannot ship out its raw materials or their parts of components to the rest of the world, so there is a supply shock and a lag behind in the goods and in the goods. So what about like Hong Kong traders to deal with these issues? So in the first quarter of this year, HKTDC had conducted a survey which we interviewed like 500 traders and manufacturers in Hong Kong. And like 75, actually 90% of them saying that like the COVID pandemic situations has caused negatively affected to their business. And among them, like 75% of the respondents said that the increased transportation cost is their main concern and their main challenges. And actually this has been rise from 60% from the previous quarter. And we can see that the logistic bottleneck is still being a concern, and it is still the biggest concern of Hong Kong traders and manufacturers. And in addition, the disruption to logistic and distribution arrangement has also caused problems to Hong Kong manufacturers and traders. And we can see that 64.5% respondent reported that is an issue to them. And however, like the shortage of raw materials and parts and components are also their concern. So therefore, the logistic bottlenecks had negatively affected like Hong Kong manufacturers and traders. So what did they do to like mitigate the problem? So for Hong Kong traders, they are trying to like use the just-in-case inventory strategies to cater the problem of logistic bottleneck. Like because in the past, many traders they use a just-in-time inventory system to manage their stock, which they only receive the goods as close as possible when they actually need them. But however, under this like new disruption, therefore, like just in time has to be switched to just in case strategies. So many of the international players, like they are trying to stock more inventory just in case they are faced with the disruption again. So however, the problem is that you can't ship the goods outside from China. So what can they do? And actually, before like the China-US trade war, like some big companies already like think of like China plus one strategies or China plus two strategy to diversify their supply chain basis, not just only focusing on China. And also they also try to have their manufacturing plants like relocate to rebalance to like the other parts of the world, for example, ASEAN, not just focusing on China as the major supplier of their raw materials. So since therefore many MNC have set up their subsidiary manufacturing plants in Asia. And because of that, we can see that the regional comprehensive economic partnership is becoming more important in the region. And this RCEP agreement has been entered into force in this year, January the 1st. And the economy of RCEP actually like creates the world's largest trading bloc by economic size, and it's almost cover 30% of the world's population and the world's global GDP. So it not only foster trade, but also investment relations within the bloc and within their member to further enhance like the regional economic integrations. So although Hong Kong is not a member of RCEP yet, to be unfortunate, but we have already applied to join the RCEP in February. So actually, if you look into the Hong Kong Free Trade Agreement, we already have like 13 FTA with the RCEP members, except Japan and Korea. So like actually Hong Kong, if you look at the Hong Kong trade with between the RCEP member, it actually accounted almost like 70% of like Hong Kong total trade balance. And to look at the impact of the RCEP to our Hong Kong traders or the China manufacturers, we actually conduct a survey in the first quarter of this year, and we, in the Hong Kong and the GBA cities, like including 9 mainland cities and Macau as well. And we actually interviewed 1,000 manufacturers and traders in the Greater Bay Area region. And they also say that like RCEP as a catalyst for operational changes. Like for example, speaking of transformation, like over the 1 to 3 next year, 46% of the respondents are expected that like RCEP can change their trade and supply chain mode within the region. So they will also increase their sourcing of goods and services from the RCEP economies. And 44% said they would like export more goods and services to RCEP member. So we can see that the RCEP have given like a hope to like all the like GBA manufacturers and traders. But if you look at trade with non-RCEP economies, we can see that like within the green bar, we're saying that like in the next 1 to 3 years, they will increase also like sourcing goods and finding services provider with the non-RCEP economies. It is because like I believe that once the RCEP has taken into force, like with the trade, with the tariff, lowering the tariff to 0%, like although it's take like maybe 20 years times, but with gradual tariff decrease, we can see that like the supply chain will be getting more complex in the region. It is because like the goods, the semiconductor or the semi-fine product goods, they can like travel or they can ship to further manufacturing within the RCEP members countries like freely and without like additional tariff. So that's why it gives like a multi-year window of opportunities like in the short term and in the longer term. So we can see that with the RCEP, we understand that like how implementation of the RCEP would affect our GBA respondent business revenue. And surprisingly, like within this year, 2022, although like less than 10% saying that it is very positive, but it's rather positive is saying that almost 40% of that. So RCEP, the implementation of RCEP actually facilitating like the intra-regional trade between like RCEP members. So if you're looking at beyond like 2025, you can see that like rather positive and very positive are still like being the major taking the major share. So if you look at the GBA manufacturers and traders, their view, RCEP will do no harm. Very negative is like almost zero in our survey. So the key takeaways like is that like the supply chain is like increasing reliance on digitalization and the trade and the data that can be generated at every point in a product's journey. Because like as I mentioned before, like in the 14th five-year plan, China is actually upgrading its like manufacturing plans and applications, while like cloud computing and big data and AI and robotics, like these automations are leading like many businesses to take a fresh look in their supply chain. So time is money, and then taking time to take action is very crucial during like this supply chain like disruption. And Hong Kong has been like a long-standing strength in the areas such as like legal and professional service. And we have like professional shipping consultants, and they can like help you to find a route like to ship out your goods from China, not by sea, but or maybe by rail or by other means of transportation. So in this like changing circumstances, I think Hong Kong is still playing a key role in the supply chain challenges during this time. So if you have any questions, feel free. And if you have time, please take a look at our website for further information. Thank you.
Great. Let's see. I'm not muted. Great. Alice, thank you so much for that. Lots of information there. One quick question to you before I get to some other questions, and we have about 10 minutes max because we want to finish on time. Are you aware of a distinction between inflation in mainland China and inflation in Hong Kong? Is that like a relatively known number and distinction?
Actually, the inflation in Hong Kong is we call CPI, and then is around 2%. Like it's not edging up like severely in Hong Kong yet. And the China inflation is basically like led by the consumption on food, and energy price in China is controlled by the government, so it's not playing a huge impact on China's inflation yet.
Got it. All right. Thank you. So I'm going to try to condense a number of questions we have. And like I said, probably maybe keep it to 5 or 6 minutes. So we have a minute to say goodbye. A couple questions, and anybody can respond to this. It might be more Paul's. It says from David, in recent weeks, there's been some stories in the media that the Biden administration is considering to cancel the tariffs on China imports enacted by President Trump. Would such a move have a dampening effect on inflation? And can you project the potential impact from dropping of tariffs? Anybody want to take that one on?
Yeah, I'll take that. Yeah, I think the bottom line is, very, very minor, almost negligible effect. For a few reasons. One is that typically, again, we're talking CPI inflation and upstream inflation, other than perhaps oil prices, but products, intermediate products, upstream commodities. When those prices fluctuate, say there are indices that capture this, such as the wholesale price index or the producer price index. Typically, a lot of those costs are kind of absorbed through the production or the supply chain and don't necessarily get reflected much. So when you reverse them, the same thing happens. Also, it highlights another point. The question highlights another point, that when economists talk about inflation, they're really talking about a continuous process of the price level rising rather than a one-off shift in relative prices. So changes in tariffs really typically will give you just a one-off shift. Now, obviously, if that one-off shift is in the direction of lowering prices, again, it will have some small effect in that direction, but it's not something that's going to be a driver of inflation overall.
Okay, great. Question from Andrea says, how do you view China's zero COVID policy impacting supply side further in 2022? So I think maybe the question is like, do you see it somehow continuing to affect supply side negatively, or will it somehow, resolve itself? I guess it's, I don't know how to put it other than that. If it continues, I guess if COVID continues and zero COVID continues to be chased, but still chasing all the time, presumably the answer is it's going to continue to affect supply side.
Yeah, perhaps I'll come in again. I mean, I told my story in terms of we had this sort of the COVID for, best part of 2 years coming out of that. And now we have this Russia-Ukraine shock, which has many similar elements in terms of disrupting supply chains and causing bottlenecks and diverting trade, etc. But the China COVID story is even worse because it says, no, COVID is not over. And as Alice, I think, made these points very well, I mean, the largest manufacturing hub in the whole world. And if, personally speaking, zero COVID, I mean, good luck with that. That is really delaying the inevitable in some sense. So, this could be like a perfect storm. I hate to be negative too much. I like to be more optimistic usually, but it's almost a perfect storm situation if we have through 2023, through 2022 and into 2023, the COVID story kind of continuing in the, such an important economy as China. And we saw some of the evidence of that in some of the charts that Alice had as well.
Yeah, and I'm suspecting that even the most pro-US or Western person on that wouldn't really wish that upon China, because that's going to have consequences for everybody, right? So that's negative, and no need to make up that that's happening, because it wouldn't be good, I suppose, for anybody. There's a question that says, essentially says, the U.S. has a likelihood of going into recession, based on inflation issues and fighting inflation and all of that. Is it likely that either China would go into a recession as a result of that, or kind of independent and equally be headed towards recession?
Again, as maybe someone else might want to come in, but very quickly, China is such a big continental size economy, which is now driven so much by domestic demand related to its own economic development, that I don't think a recession in the US, necessarily translates into a recession in China. It partly depends on how you define a recession, because in China, you would normally think of it more as a growth recession. That is, you still have a positive growth rate. Maybe it's 2, 3, 4%, but it's not your 6 or 7%. But I think, China, has the necessary tools and the necessary kind of domestic demand potential to dodge that bullet. But at the margin, it's certainly would not be a positive factor. Depends a little bit also, Don, on what is causing the recession in the US. Is it a global factor that is also impacting China? So in that case, China could be impacted not because of the linkage to the US, but because of the underlying factor. If it was something to do with global confidence, for example, or something related to geopolitical developments.
Yeah, I would like to add a point, Don.
Yes.
Yeah, for the China recession, I don't think it will be coming soon, because according to the China 14th Five-Year Plan, if you have been aware that it doesn't set a GDP growth in this run, unlike the 13th Five-Year Plan, it always set a GDP growth target. This year, because actually the plan was announced last year, China has been realized that facing all the world challenges like pandemic and right now the inflation and the Ukraine war, and China didn't set a GDP growth target, and actually it has been presumed that our IMF predicted that China growth will be around 4.4% this year. And a point to add that is China is actually stimulate its economy, like focusing on the dual circulation strategies, like as Paul mentioned that like apart from like stimulating the consumption demand locally, it also like stimulated like consumption demand to the from the outside world, for example, like goods and services as well. So therefore, like I think the China economic growth will be like positive this year, but like may not be as much as like last year, like around 6%, like maybe like 4% around, maybe.
Yeah. I suppose it's a matter of definition, as you suggested, Paul, and maybe 3 or 4% is kind of a recession in some way. If it really is a technically negative growth recession in China, then everybody's got a lot of other big problems. That's a calamitous. I mean, that's another story, right? So,
Yep.
Damien, I don't know if you have anything to suggest on that.
No, I've very much enjoyed hearing Paul's analysis and yours too, Alice. So
Great. So there's 3 questions that are essentially all the same. So I think instead of just asking the question, we'll do one of those where you all have to say yes or no or something like that. So the basically 3 questions is how long will this last? And so maybe we'll tell everybody you have to say if it's going to last 1, 2, or more than 2 years before supply chains and inflation get under control. So
I'm going to say 1 year.
1 year will be in better shape, according to Damien. Alice?
Well, if China is still doing like a zero COVID policy, I think like maybe more than a year, like because like China is still the world's like factory, and I can't see like if it still like doing using lockdown strategies to solve the COVID problem. I don't think is help the economy much or help the world's economy much overall.
Right.
Yeah.
And Paul, final word?
Yeah, I would go for, I think, more like 2 years, and partly because we haven't talked a lot about the sanctions and the Russia situation. That's still a moving object, and a lot of the sanctions, the European ones in particular, are going to come through with a bit of a lag. And I think that's going to play out over this year, but also have consequences into 2023. So I'm going to go for 2 years.
Yeah, I think unforeseen consequences, even unpredictable. So great. Thank you so much for everybody. Really excellent discussion. Thank you for your time and participating, Alice, Damien, and Paul, and Candy as well. Quick commentary by Michelle about a couple upcoming events, and then we'll say goodbye.
Yep, thank you, Don. Appreciate everyone's support for our event tonight. Just want to announce a few additional upcoming events for all of you. Like this Friday, HKETO New York and our sister association at Atlanta, they are going to host the webinar Hong Kong Still Matters. The speakers will discuss the new advantages of growing business in Hong Kong and why the city still matters as an international business international business hub. And on May 24th, HKTDC is hosting the webinar Explore Opportunities for China and Asia via Hong Kong. The speakers, they will dive into the market opportunities and also resources available for all US companies. And they, of course, they will also include the insights on the booming Greater Bay Area market in China. Last but not least, on June 21st, the National US Hong Kong Business Association is hosting our first virtual networking mixer. So if you're interested in knowing more about the network or exploring new business connections, then you don't want to miss this. So all of these event links, they are in chat panel right now. Feel free to check them out, and also looking forward to seeing you all again.
Great. Thank you, Michelle. And I see we're only 3 minutes over, so I apologize for that, but I'm trying to keep it to that. So with that, we'll say thank you again to all the presenters, and thanks to all the attendees for participating. And we hope to see you again soon at another event. Have a good night or good morning.
Cheers. Thank you.
Thank you. Good day.